Hi everyone. What we are looking at is the UK UAE Double Taxation Convention that was updated on 21st October 2019. Uh, Quite a few articles are provided, the usual contents of any double tax avoidance agreement we will find in this DTA as well. So I will directly go to the initial Article 1, the persons that are covered. This convention shall apply to the persons who are residents of one or both of the contracting states. The word contracting states refers to both UAE and UK. Nothing in this convention shall affect the right of either contracting state, any political subdivisions, local governments, or local authority to apply its own laws and regulations related to the taxation of income and profits derived from hydrocarbons situated in that state. So naturally, UAE is one of the major chunks of income of UAE is derived from hydrocarbons. So that explains why this clause is in particularly incorporated into the double tax agreement. So UAE wishes to apply their local laws onto the incomes and profits derived from the hydrocarbons. Article 2, taxes covered. Naturally, covered taxes is an essential part of the double tax agreement. This convention shall apply to taxes on income and on capital gains imposed on behalf of contracting state or of its political subdivisions. So basically, both income as well as capital gains are covered. Uh, there shall be regarded as taxes on income. Uh, And on capital gains, all taxes imposed on total income or on elements of income, including taxes on gains from alienation of movable or immovable property. So, property related gains are also covered within this agreement, in addition to taxes on income or on capital gains. The existing taxes to which the convention shall apply are, in particular, in case of United Arab Emirates, the income tax, the corporate tax. We think we are aware that personal or natural person income taxes are not imposed. No, employment taxes are not there in UAE, but although this agreement was effective, before the corporate tax introduction in UAE, but the corporate tax was covered in this double tax avoidance agreement. And then, in case of United Kingdom, the taxes that are covered are income tax, corporation tax, and capital gains tax. So naturally, UK already has income tax, so that angle has been covered. Corporate taxation is covered, and similarly, capital gains tax is also covered. The convention shall apply also to any identical or substantially similar taxes that are imposed after the date of signature of the convention, in addition to or in place of the existing taxes. The competent authorities of the contracting states shall notify each other of any significant changes. So an understanding between the two contracting states that in case of any major changes, that has to be informed to the other contracting state. Now, Article 3 provides the general definitions. uh, the the term UAE, United Arab Emirates, naturally means UAE, United Arab Emirates, and the geographical sense means that the territory of the mainland and islands under the sovereignty, including the territorial sea and space. So the entire, the predominant meaning under the international laws of UAE has been kept intact. Similarly, the term UK, United Kingdom, means Great Britain and Northern Ireland, and when used in geographical sense, means the territory and territorial sea of Great Britain and Northern Ireland, and the areas beyond the territorial sea over which Great Britain and Northern Ireland exercise sovereign rights. Business includes performance of professional services and of other activities of an independent character. So the key word here is independent character. The term company means any body corporate or any entity that is treated as a body corporate for tax purposes. So the internationally accepted meaning of this word body corporate alludes to the fact that that entity, that vehicle, assumes a separate personality from the owners, and it can sue the owners and be sued by the owners. So it's a separate entity. The term competent authority means, in case of the United Arab Emirates, the Minister of Finance or his authorized representative. And in case of UK, the Commissioners for Her Majesty's Revenue and Customs or their authorized representative. Uh, the terms a contracting state and other contracting state means the United Arab Emirates or the United Kingdom in the as the context required. The term enterprise applies to the carrying on of any business. So wherever the word enterprise comes, it will mean carrying on of any business. The terms enterprise of a contracting state and enterprise of the other contracting state means respectively an enterprise like a business venture, business activity carried on by a resident of a contracting state and an enterprise carried on by a resident of the other contracting state. So here, whenever enterprise of a contracting state comes in, that means a person who is ascertained. Why do I say ascertained? Because in the later part of this double taxation agreement, we are going to look at what would constitute a resident. So an enterprise that is run by a resident of either of the two countries. The term international traffic means any transport by ship or aircraft, except when the ship or aircraft is operated solely between places in a contracting state and the enterprise that operates the ship or aircraft is not an enterprise of that state. So the basically a foreign enterprise that carries on the business of shipping or transportation, whether it is a ship or an aircraft, and which is operated solely between places in a contracting state, and the enterprise that operates the ship or aircraft is not an enterprise of that state. So, a foreign enterprise that is operating in the other contracting state. The term national would mean, in respect to the United Arab Emirates, any individual possessing the nationality of the UAE, or for that matter, any legal person, partnership, or association deriving its status as such from the laws in force of the UAE. So we have different types of legal vehicles in UAE. Even a partnership company or general partnership is also issued a trade license. So all of those would be covered. As a matter of fact, even a sole establishment, which basically is an individual running a business, that would also be covered in here. Uh, then we have another clause in relation to the United Kingdom. That the previous one was regarding UAE. Now we're coming to the UK. Any British citizen or any British subject not possessing the citizenship of any other Commonwealth country or territory. That's a very interesting angle. Either a British citizen or a British subject. So, citizen would mean passport holder, but a British subject might not mean a passport holder of the UK. Not possessing the citizenship of any other Commonwealth country or territory, provided he has the right of abode in the United Kingdom. And any legal person, partnership, or association deriving its status as such from the laws in force of the United Kingdom. So basically, it covers those individuals who either have a British passport or even if not, they have a right of abode, the living right in the UK. And besides individuals, those legal persons, partnerships, or associations who derive this status from owing to the laws of the UK. So national, the term national applies not only to individuals but also to legal entities. The term pension scheme means any scheme or other arrangement which is generally exempt from income taxation. Pension scheme uh, refers to those schemes which are generally exempt from income taxation and op, uh, operates to administer or provide pension or retirement benefits or to earn income for the benefit of one or more such arrangements. So that would be the meaning of the word pension. Uh, it is properly administered to provide pension or retirement benefits or to earn income for the benefit of one or more such arrangements. So naturally, a pension fund sometimes invests money into profitable ventures as well for the benefit of the of those who are part of that pension scheme. The term person includes an individual, a company, and any other body of persons. So that's a very broad definition that would even include those forms of entities which might not be companies, but still they are they are a body of persons. So that would also be included in the term person. For example, this could be a partnership, for example, association of persons. The term recognized stock exchange means the Abu Dhabi Securities Exchange ADX, Dubai Financial Market, which is DFM, the Abu Dhabi Global Market, ADGM, Dubai Gold and Commodities Exchange, any successors there too, and any other United Arab Emirates investment exchange recognized under the United Arab Emirates law. This is for the UAE, and then for UK, it would mean London Stock Exchange, any successes there too, and any other United Kingdom investment exchange recognized under the UK law, and any other stock exchange agreed upon by the competent authorities. So, if it is not covered within what has been provided in the provision, but both authorities of UK and UAE agree that this exchange would be covered under this double tax agreement, then that exchange would be deemed as covered by this agreement. As regards the application of the convention at any time by a contracting state, any term not defined therein shall, unless the context otherwise requires, have the meaning that it has at that time under the laws of that state for the purpose of the taxes to which the convention applies, any meaning under the applicable tax law. So in summary, what is being said is that if there is a terminology or there is a subject that has for which this double taxation agreement application of this DTA is being evaluated and it is not very clearly defined, then it will be referred to the laws of the two states which define that terminology for the purposes of of taxes to which this convention applies. Any meaning under the applicable tax laws of the state. By the way, when we talk about law, we're referring to tax laws prevailing over a meaning given to the term under other laws of the state. So the meaning that is given by the tax laws will always prevail over other laws. Now we come to a very crucial article, Article 4, which is resident. The term resident of a contracting state means, in case of United Arab Emirates, any individual who, under the laws of the United Arab Emirates, is domiciled in the United Arab Emirates or has his habitual abode or center of vital interest in the UAE. So, three things: either a domicile in the UAE. Uh, Domicile again is a terminology or an expression used to indicate presence, a physical presence, maybe a house, and which has been later on defined as habitual abode. But in case of a legal entity, domicile would mean incorporation or a place of establishment. Similarly, another concept of center of vital interest has been identified, has been stipulated in this provision, which would mean perhaps a headquarter or a holding company or even a company that has economic interests. So these various meanings would be covered. Any individual who, under the laws of the UAE, is domiciled or is living here, place of habitual abode, or has vital interest, vital economic interest in the UAE, that person would be covered under the meaning of the word resident. Any person other than an individual. Now we're talking about non-natural persons, which is legal person, other than an individual that is incorporated or otherwise recognized under the laws of the United Arab Emirates or any local government or local authority thereof. So this expression again is quite similar to what has been provided in the UAE tax law as well. So those body corporates who are either incorporated or otherwise recognized as having a legal personality under the laws of the United Arab Emirates. But how do we look at it in case of United Kingdom? Any person who, under the laws of the UK, is liable to tax therein by reasons of his residence, place of management, place of incorporation, or any other criteria of a similar nature. So the interesting angle has been that a person who is liable to tax in UK, and what could be the reasons of his he that person being liable to tax? It could be his residence. It could be the place of management, which is the poem concept, place of effective management, or place of incorporation, or any other criteria of a similar nature. So all of these categories of persons will be considered resident when in the context of United Kingdom. The term, however, does not include any person who is liable to tax in the United Kingdom in respect only of income from sources in the United Kingdom. So that's an exclusion clause. The term, however, this term resident does not include any person who is liable to tax in the UK in respect only of income from sources in the UK. So that's a geographical source of income angle. So if a person is earning income only from the soil of UK, that person is excluded from the scope of this double tax agreement. The term resident of a contracting state includes the state and any political subdivision or local government or local authority thereof, and any statutory body, agency, or instrumentality of the state. So, resident of contractor state includes that state and any political subdivisions. So UK, United Kingdom, as the name suggests, has a, fairly large sovereign jurisdiction. So any political subdivision, local government, all governing authorities, sovereign government governing authorities, will be covered within the meaning of the word state. A pension scheme established in that state, and any organization that is established and is operated exclusively for religious, charitable, scientific, cultural, or educational purposes, or for more than one of those purposes, and that is a resident of that state according to its laws, notwithstanding that all or part of its income or gains may be exempt from tax under the domestic law of that state. So, welfare organization basically, but it could be charitable or it could be, religious, scientific, cultural, or educational purposes organizations will, even if they are exempt, they will be considered within the scope of this double tax avoidance agreement, where by reason of the provisions of paragraph 1, an individual is a resident of both contracting states. So that's where the dual residency comes in. Then his status shall be determined as follows. Now we're talking about this is a tiebreaker clause. He shall be deemed to be a resident only of the state in which he has a permanent home available to him. So primary criteria, permanent home availability. If he has a permanent home available to him in both states, okay, so the first criteria is neutralized because the person has homes in both UK and UAE, then what will happen? He shall be deemed to be a resident only of the state with which his personal and economic relations are closer. center of vital interest. So, for example, one simple example could be okay, a person has a home in UK as well as UAE, right? And because of this reason, he's being seen as a resident of both states, dual residency. Then the next tier basically will go to the next test, and that will be center of vital interest. For example, which of the two countries this person has a company incorporated in, or uh, o- which of the two countries the person has active business presence, for example. Company incorporation can happen in both countries, but what about, for example, quite a few expats may incorporate companies in UAE only for the purpose of getting a visa, right? But that's not an active business scenario. But the active business might be in UK. In that case, that person will be seen as the tax resident of UK. Although he has home in both countries, he even has companies in both countries, but active business presence is in UK, then that person will be seen as tax resident of UK. Uh, if the state in which he has his center of vital interest cannot be determined, now again a complexity arises. Okay, the person has economic interest in both places. He's doing active business in UK as well as UAE. Then what to do? Or if he does not have a permanent home available to him in either state, he shall be deemed to be a resident only of the state in which he has a habitual abode, where the person usually lives. By way of habit, he is living there. So, habitual abode will be the third tier, third test that can be applied. So, the, for example, there is a UK citizen who moved to UAE. All the previous criteria are neutralized. Both places he has central of vital interest. Which country's resident will he be? The answer would be where he is living for the majority of the time during the year, habitual abode. For example, if the person is living in UAE for most of the time duration in a year, then he will be deemed as the tax resident of UAE. If he has a habitual abode in both states, now again a very interesting scenario. If he's living in both states almost equally, or in neither of them, he shall be deemed to be a resident only of the state of which he is a national. Even if the habitual abode criteria is neutralized because of his presence in both countries simultaneously of equal duration, then what will happen? Then the focus will shift to his nationality. If he has a UK passport, for example, then he will be deemed as a resident of UK instead of UAE. If he is a national of both states, now further complexity. It will be very rare situation, but it can happen because see, UAE does not usually grant nationality to foreigners. Rare instances are there where expatriates have been granted UAE nationality, but it could be other way around as well. A UAE resident, sorry, a UAE national has gone to UK. The granting of nationality in UK is definitely more lenient than UAE. So originally the person was an Emirati. He had a Emirati passport. He was born in UAE. He went to UK and got the nationality of UK as well. So if that is the case, if he is a national of both states or of neither of them, the competent authorities of the contracting states shall settle the question by mutual agreement. So then the last resort will be the mutual agreement procedures between the two countries. Where by reason of the provisions of paragraph 1, a person other than an individual, a legal personality, legal person, is a resident of both contracting states. Uh, you know, because of the, for example, we read earlier that in UK, because of the poem reason, one legal entity can become a tax resident of UK, which may be established or incorporated in UAE. So if that happens, a person other than an individual is resident of both contracting states, then the competent authorities of the contracting states shall endeavor to determine by mutual agreement the contracting state of which that person shall be deemed to be a resident for the purposes of this convention. So again, if there is a tie, if there is a tie between his that entity, legal entity's tax residence, because it is apparently that entity is resident of both the states, then mutual agreement procedures will apply between UK and UAE, and the tax residence will be determined. In the absence of a mutual agreement by the competent authorities of the contracting states, let's say even that fails and both competent authorities are not able to reach a conclusion, the person shall not be considered a resident of either contracting state for the purposes of claiming any benefits provided by the convention except those provided by Articles 21, 22, and 23. So, if that situation arises where uh, both competent authorities are not able to conclude as to which uh, country's tax resident that company is, then that company will not be seen as resident of either of the contracting states. Then that company will not even be tax resident of UK nor UAE. However, only certain, the Articles 21, 22, and 23, which we are going to read later. Actually, we can quickly look at the names of the Articles 21, 22, and 23. So, Article 21 would be elimination of double taxation. Of course, that's this the intention of the article is how to eliminate double taxation. Article 22, non-discrimination. No discriminatory treatment shall not be applied. And Article 23 is mutual agreement procedure. So these, except for these three matters, that person will be seen as out of the scope of this uh, double taxation agreement. So coming to Article 5, which is a burning topic of today, permanent establishment. For the purpose of this convention, the term permanent establishment means a fixed place of business. It is a commonly worldwide used concept of permanent establishment, a fixed place of business through which the business of an enterprise is wholly or partly carried on. So, if any organization, any business has a fixed place in a country where conduct of activity happens, this will be seen as permanent establishment of that business. The term permanent establishment includes especially a place of management, a branch, an office, a factory, workshop, mine, an oil or gas well, a quarry, or any other places of exploration for or exploitation of natural resources. And these were uh, some of the examples of permanent establishment. But in addition to that, a building site or construction or installation project constitutes a permanent establishment only if it lasts more than 12 months. So if there is a construction work or installation project, if it is longer than 12 months, then this will also be seen as permanent establishment. Notwithstanding the preceding provisions of this article, the term permanent establishment shall be deemed not to include the use of facilities solely for the purposes of storage, display, or delivery of goods. Now, these are exclusions from the concept, from the meaning or interpretation of permanent establishment, because these are, not the purpose of only storage or display or delivery. That's not core business activities. This is ancillary or support activities or merchandise belonging to the enterprise. The maintenance of a stock or stock of goods or merchandise belonging to the enterprise solely for the purposes of storage, display, or delivery. These are again all ancillary activities. The maintenance of a stock of goods or merchandise belonging to the enterprise solely for the purpose of processing by another enterprise. Right. So storing on behalf of another for the purpose of another enterprise who's going to use these stock of goods or merchandise. That if it is a place of maintenance of such stock, that will not be seen as permanent establishment. Maintenance of a fixed place of business solely for the purpose of purchasing goods or merchandise or of collecting information for the enterprise. Usually a rep office in UAE, that structure is only for collecting information, etc. Or there can be a facilitation for purchase of goods or merchandise also. So again, it's a support activity. The maintenance of a fixed place of business solely for the purpose of carrying on for the enterprise any other activity of a preparatory or auxiliary character. So preparatory, auxiliary, ancillary character, those activities, if there is a place on which such activities are being conducted, it will not be seen as permanent establishment. The maintenance of a fixed place of business solely for any combination of activities mentioned in those previous paragraphs A to E, provided that the overall activity of the fixed place of business resulting from this combination is of a preparatory or auxiliary nature. So, uh, maintenance of a fixed place of business solely for any of the combination, meaning more than one things from A to E, more than one activities from A to E is happening, more than one activities, then if you combine the overall effect of those activities and it is still of a preparatory or auxiliary nature, then it will not be construed as permanent establishment. Now, another very interesting paragraph, notwithstanding the provisions of paragraph 1 and 2, where a person other than an agent of an independent status to whom paragraph 6 applies, paragraph 6 is the next paragraph, is acting on behalf of an enterprise and habitually exercises in a contracting state an authority to conclude contracts on behalf of the enterprise. So basically, a senior executive, think of it as a director, senior executive who lives in one of the contracting states and he habitually exercises the authority of concluding contracts, etc. That enterprise shall be deemed to have a permanent establishment in the state in respect of any activities which that person undertakes for the enterprise, unless the activities of such person are limited to those mentioned in paragraph 4, previous paragraph, which is like an auxiliary nature. If exercised through a fixed place of business, would not make this fixed place of business a permanent establishment under the provision of that paragraph. But guys, you don't have anything. A company sitting in UK sends a director to UAE, and that director just takes an office, sits there, and concludes contracts. Exercises authority, which does not, or which does not involve getting approvals from UK, or it's just a formal approval from UK. Whatever he agrees or concludes, that is seen as almost approved by default. Then that person usually is referred to as a dependent agent, and presence of that dependent agent in a fixed place of business, that constitutes a permanent establishment. An establishment shall not be deemed to have a permanent establishment. An enterprise shall not be deemed to have permanent establishment in a contracting state merely because it carries on business in that state through a broker, general commission agent, or any other agent of an independent status. So too many businesses have invested monies through a broker here, an investment manager, for example. So that investment manager by default is not going to become a permanent establishment, because that investment manager or a broker, they're operating in their independent status. They're not dependent on only this particular client, provided that such persons are acting in the ordinary course of their business. The fact that a company which is a resident of a contracting state controls or is controlled by a company which is a resident of other contracting state. So now we're coming to the angle of control. The fact that a company which is a resident of a contracting state or is controlled by a company which is a resident of the other contracting state, or which carries on business in the other state, whether through a permanent establishment or otherwise, shall not of itself constitute either company a permanent establishment of the other. So, a subsidiary will by default not become permanent establishment of the parent, in easier words. Okay. Just because of the fact that it is controlled by the parent sitting in UK, the company operating in UAE will by default not become a permanent establishment of the parent company located in UK, or vice versa. Now we're coming to Article 6, which is income from immovable property. Uh, Income derived by a resident of a contracting state from immovable property, including income from agriculture or forestry, situated in the other contracting state, may be taxed in that other state. Okay. Income derived by a resident of a contracting state from immovable property situated in the other contracting state may be taxed in that other state. So a UK company owns a building here in UAE, then the revenues of that building can be taxed in UAE. That's just an illustration. The term immovable property shall have the meaning which it has under the law of the contracting state in which the property in question is situated. So in our example, the building was in UAE. So immovable property will have the same meaning as it is carried on in the tax law of the UAE. The term shall in any case include property accessory to immovable property, livestock and equipment used in agriculture and forestry, rights to which the provisions of general law respecting landed property apply. So, this term shall include, other property which is accessory to that immovable property, livestock and equipment used in agriculture and forestry. So, rights to which the prop provisions of provisions of general law respecting landed property apply. Uh, Usufruct of immovable property and rights to variable or fixed payments as consideration for the working of or the right to work, mineral deposits, sources and other natural resources, ships and aircrafts shall not be regarded as immovable property. So, if we carefully look at the last part of it, what will not be seen as immovable property that has been uh, explained. Usufruct of immovable property, uh, basically renting, right? The rights to variable or fixed payments as consideration of the working of or the right to work, mineral deposits, sources and other natural resources. Until this part, it was all income from immovable property. But the last part is ships and aircraft shall not be regarded as immovable property. Okay. The provisions of paragraph 1 shall apply to income derived from the direct use, letting, or use in any other form of immovable property. So, right, this paragraph 1, which was income derived by a resident of a contracting state from immovable property can be taxed in that other state. This provision shall apply to income derived from the direct use, letting, or use in any other form of the immovable property. The provision of paragraph 1 and 3, one that the immovable property income can be taxed in that country where that immovable property is located, that and non-encumbrance of any income related to that property, and the fact that it can be taxed in the country of location, uh, that is being addressed here. The provisions of 1 and 3 shall also apply to the income from immovable property of an enterprise. Right, so it can be the immovable property of an individual, it can be that of an enterprise as well. It will not make a difference. The provisions shall continue to apply. Now we are coming to the heart of the corporate taxation, which is business profits. Article 7. The profits of an enterprise of a contracting state shall be taxable only in that state unless the enterprise carries on business in the other contracting state through a permanent establishment situated therein. So, first thing, the profit of an enterprise of a contracting state shall be taxable only in that state where that enterprise is incorporated or recognized, unless the enterprise carries on business in the other contracting state through a permanent establishment. For example, a branch. A UK company's profits will be taxed in UK. That's the default rule. But what if that UK company has a branch in UAE? That branch is a permanent establishment, a UAE permanent establishment. Then that's an exception. Then that branch profit will be taxed in UAE. If the enterprise carries on business as aforesaid, the profits of the enterprise may be taxed in the other state, but only so much of them as is attributable to the permanent establishment. That's profit attribution to permanent establishment. So all the branches maintain their own books, etc. That should give the ascertainment of how much profit is attributable to permanent establishment. There may be complex situations as well where a profit may need to be there may be involvement of a calculation based on various functions and the deployment of assets and risk assumed, etc. But those are complex situations. The easier interpretation is the fact that those branches or permanent establishments should have straightforward indication of how much amount of revenues they generated, how much value was derived generated in the country where this permanent establishment is located. Subject to the provisions of paragraph 3, which is the next paragraph, where an enterprise of a contracting state carries on business in the other contracting state through a permanent establishment situated therein, there shall be in each contracting state, there shall in each contracting state be attributed to that permanent establishment the profits which it might be expected to make of it. So, the so basically the it's profit anticipation being it's an indication of the arm's length principle as well. Let us read it again. Subject to the provisions of paragraph 3, where an enterprise of a contracting state carries on business in the others contracting state through a permanent establishment situated therein, there shall be in each there shall in each contracting state be attributed to that permanent establishment the profits which it might be expected to make if in it. I think this make if it is a mistake, make in it. Were a distinction and separate enterprise, were a distinct and separate enterprise engaged in the same. Oh, okay. So this is correct. So it's basically it's one and the same sentence. So I'm going to read it again. So there shall in each contracting state be attributed to that permanent establishment the profits which it might be expected to make if it were a distinct and separate enterprise engaged in the same or similar activities under the same or similar conditions and dealing wholly independently with the enterprise of which it is a permanent establishment. That's a cardinal rule of international taxation actually, which is endorsed by the BEPS Pillar 2 as well. That permanent establishments will be seen as independent bodies, independent business entities, segregated from their parent. So we will look at them as separate entities doing their business, and we are going to look at their profits as if they were separate entity, and we are going to this double taxation agreement says that the tax will be imposed according to this principle only. So this will have arm's length principle uh, dynamics associated with it. It is going to come in the later paragraphs. In determining the profits of a permanent establishment, they shall be allowed as deductions expenses which are incurred for the purpose of the permanent establishment, including executive and general administrative expenses so incurred, whether in the contracting state in which the permanent establishment is situated or elsewhere. So again, I mean, it's a fair treatment of certain expenses that may have been incurred in the parent company, may in UK, but a certain part of that expense relates to the branch that is located in UAE. So that attribution of expenses will be allowed. So as deductible expenses for tax purposes. No profits shall be attributed to a permanent establishment by reason of the mere purchase by that permanent establishment of goods or merchandise for the enterprise. So, just because a branch did procurement on behalf of the parent entity situated in UK, for example, then just because of the fact that it acted as an agent to do a purchasing activity, uh, uh, profits attributed to that particular inventory or stock of goods, they will not be allocated to the branch. Yes, there may be other aspects like an administrative fee or something. That will be a fair thing to do. But other than that, core income generating activity related profits will not be attributed to that branch because it was only acting as an agent, maybe a procurement agent. Where profits include items of income or capital gains, which are dealt with separately in other articles of this convention, where profits include items of income or capital gains which are dealt with separately in other articles of this convention, then the provisions of those articles shall not be affected by the provisions of this article. So we might see capital gains, for example, there will be a separate article. So the treatment of such items, capital gains, dividends, maybe interest, those will be dealt with under separate articles of this double tax agreement. So for each such things, such items, there are other articles mentioned here. So, Article 8, another important aspect of international taxation, shipping and air transport, that has been duly addressed in the Model Tax Convention as well. That is addressed here now. Profits of an enterprise of a contracting state, profits of an enterprise of a contracting state from the operation of ships or aircraft in international traffic shall be taxable only in that state. So, profits of an enterprise of a contracting state from the operation of ships and aircraft in international traffic shall be taxable only in that state. So, for example, if it is a UK company operating ships or aircraft in international traffic, then the taxation of such a company will happen only in UK. It will not happen in UAE. The provisions of paragraph 1 shall also apply to profits from the participation in a pool, a joint business, or an international operating agency, but only to so much of the profits so derived as is attributable to the participant in proportion to its share in the joint operations. So, such a market player who is into shipping and air transport business can be involved in a joint venture, like a pooled business, or as part of an international operating agency. So, naturally, in that kind of a scenario, profit attribution will need to be made. A fair profit attribution will need to be made to that entity, to the participant in proportion to its share in the joint operation. Now, a very, very important transfer pricing related aspect of associated enterprises. This has been referred in the UAE taxation, corporate taxation law as related parties. So let us look at that, Article 9, where an enterprise of a contracting state participates directly or indirectly in the management, control, or capital of an enterprise of the other contracting state. First scenario, enterprise of a contracting state participates directly or indirectly in the management, control, or capital of an enterprise of the other contracting state. Or the same person participates directly or indirectly in the management, control, or capital of an enterprise of a contracting state and an enterprise of the other contracting state. Uh, and in either case, conditions are made or imposed between the two enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises. Meaning arm's length principle is violated. Then any profit which would, but for those conditions, have accrued to one of the enterprises, but by reasons of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. So basically, what is being said is that if arm's length principle is violated and there is an understatement or overstatement of profit, then this will be adjusted. Like one enterprise in UK has charged an excessive expenditure into the books of the branch in UAE, then the amount of expenditure which is above and beyond the arm's length benchmark, that will be disallowed. So there will be a corresponding adjustment in both books. Where a contracting state includes in the profits of an enterprise of that state and taxes accordingly, profit profits on which an enterprise of the other contracting state has been charged to tax in that other state, and the profits so included are profits which would have accrued to the enterprise of the first mentioned state if the conditions made between the two enterprises had been those which would have been made between independent enterprises, then that other state shall make an appropriate adjustment to the amount of the tax charged therein on those profits. So, if profits of the branch, for example, in UAE were taxed, and one element of the profit was excessive, was an excessive part of the profit, and so a corresponding adjustment will be made. So on one hand, the profit in the UAE branch will be dropped or reduced, and profits of the in the UK will be increased. So, this would curb the chances of shifting of profits to a lower tax jurisdiction. Naturally, I mean, in UK, a much higher taxation rate exists compared to UAE. So naturally, there will be an inclination to shift profits from UK to UAE. So that will be seen in this context. In determining such an adjustment, due regard shall be had to the other provisions of this convention, and the competent authorities of the contracting states shall, if necessary, consult each other.